All right, welcome to The Explainer. Today we are diving deep into two of the absolute pillars of fixed income, duration and convexity. Look, if you've ever wondered how the pros really manage interest rate risk, well, you've come to the right place. Let's get right into it.
So to make this real, we're going to treat this whole thing like a high-stakes consultant case. Picture this. You've just been hired to advise a massive insurance company. We're talking a $10 billion bond portfolio. And right now, interest rates are all over the place. And your client is, well, they're nervous. Your mission? Figure out their risk and build a rock-solid hedging plan. So the big question is, where on earth do you even start?
Well, you start with the first and most fundamental tool in any risk manager's toolkit, and that is duration. This is going to be our first step to really get a handle on just how much danger this portfolio is actually in.
So what is modified duration really? At its core, it gives us a pretty straightforward estimate. It answers a simple question. For every 1% that interest rates move, how much is my bond's price going to change? That's it. Think of it as a simple straight-line guess. For the math folks out there, it's the first derivative. It's just the slope of the price-yield curve at one specific point. It's our initial kind of quick and dirty number to gauge the risk.
Okay, to make this super intuitive, let's use an analogy that we're going to stick with. Imagine your entire portfolio is a car. In that case, duration is the steering wheel. It's that simple. It tells you the basic direction, right? You turn the wheel left, the car goes left. Interest rates go up, your portfolio's value goes down. It is a number one control you have for navigating the market.
But here's the thing. Not all steering wheels are built the same. Modified duration, that works perfectly for your standard, simple, option-free bonds. The plain vanilla stuff. But our client, the insurance company? Oh no, they've got complex bonds in there, things with embedded options, like callable bonds. And for those, you need a much more sophisticated steering wheel. That's where effective duration comes in. It's not just looking at one simple yield, it actually models how the bond's price is going to react when the entire benchmark yield curve moves, which is crucial when you have those tricky options to worry about.
All right, so we've got our steering wheel, we understand duration, but there's a pretty big problem. Duration gives us a straight line estimate. The reality is, the relationship between a bond's price and its yield isn't a straight line at all. It's a curve, and when you get big swings in interest rates, relying on just the steering wheel, well, it's not going to be accurate enough. We need something to correct for that error. And that correction, my friends, is called convexity. If duration is the first derivative, convexity is the second derivative. It literally measures the curvature of that price-yield relationship. So, back to our car analogy. If duration is a steering wheel, think of convexity as the car's handling, its suspension system. It's what determines how the car responds when you're taking a sharp turn or hitting a bump. It's what makes the ride smooth and keeps you on the road.
Now here's the cool part. For a normal, plain vanilla bond, this curvature is an absolutely fantastic thing for you, the investor. We call it positive convexity, and you can think of it like an airbag in your car. It's a built-in safety feature that automatically deploys to protect you when things get rocky.
And this is where the magic really happens. Positive convexity creates what we call an asymmetrical benefit, which is just a fancy way of saying it's a win-win for you. Here's how it works. When interest rates go up, your bond's price falls by less than your simple duration estimate would have you believe. It cushions the fall. But when interest rates go down, your bond's price goes up by more than duration predicted. It juices your gains, so it limits your losses and amplifies your gains. I mean, who wouldn't want that deal?
Okay, but remember our consulting case? This is where we find the skeleton in the closet. Our client's portfolio is loaded with something called callable bonds. And these bonds, they have a nasty little future that can take that beautiful positive convexity and flip it completely upside down, creating a seriously dangerous risk called, you guessed it, negative convexity.
So what's going on here? Well, our client's portfolio has a hidden trap. A callable bond basically gives the company that issued it the right to buy it back from you at a fixed price. Now, when would they do that? Of course, they'll do it when interest rates fall so they can refinance their debt more cheaply. But what does that mean for you, the investor? It means your upside is totally capped. Right when you should be celebrating because falling rates are making your bond more valuable, poof, the issuer calls it back. So you're left with all the downside risk if rates go up, but almost none of the upside if rates go down. For an institution like an insurer, that's a 5-alarm fire.
Okay, so how in the world do we fix this for our client? We know duration alone isn't cutting it. We've identified this huge negative convexity problem. But wait, there's actually another layer of complexity we have to deal with. In the real world, yield curves almost never move in perfect, neat parallel shifts. Sometimes short-term rates move, but long-term rates don't, or vice versa. And to manage that kind of risk, we're going to need some even more advanced tools.
And that's where something called key rate duration, or KRD, comes into play. Think of it like this. If regular duration is a sledgehammer, KRD is a surgeon's scalpel. Instead of just measuring how your portfolio reacts to the whole curve moving up or down, KRD lets you zoom in. It tells you exactly how sensitive your portfolio is to a change at a specific point on the curve, like just the 5-year rate or just the 30-year rate, while holding all the other rates steady. It lets us diagnose with pinpoint accuracy where our risk is hiding.
And this is just incredibly powerful stuff. Using KRD, a portfolio manager can literally break down their total risk into different buckets along the yield curve. Why is that so great? Because it lets you build laser-focused hedges. For instance, let's say you think long-term rates are going to rise faster than short-term rates, what traders call a curve steepener. With KRD, you can construct a trade that profits from that very specific change in the curve's shape, without even having to guess which way rates are going overall. It's next level.
So, for our insurance client, what's the end game? All these fancy tools we've been talking about, duration, convexity, KRD, they all serve one ultimate goal, something called Asset-Liability Management, or ALM. Look, for an insurer, it's not just about chasing the highest returns. Their number one job is to make sure that the assets they own will be there to pay out all the future insurance claims they've promised. And matching those assets to those future promises or liabilities, that whole process is called immunization. And to do this right, institutions follow a kind of immunization checklist. First, pretty obvious, the value of your assets today has to be enough to cover the value of your liabilities today. Check. Second, you've got to match the duration of your assets to the duration of your liabilities. That gets you protected against those simple parallel shifts in rates. But the third rule, this is the real pro move. You have to make sure your assets have more convexity than your liabilities. Why? Because that creates a safety buffer. It's a capital cushion that protects the entire company from those big, nasty, unexpected shocks to the system.
All right, there you have it. You've diagnosed the client's negative convexity problem, you've used KRD to understand the curve risk, and you've built a solid immunization strategy. Case closed. Now, let's switch gears and boil all of this down into a super practical toolkit that you can take with you to absolutely crush your next finance interview. Let's make sure you sound like you've been trading bonds for years.
Let's get right to it. 3 things you absolutely have to remember. Number 1, duration is the steering wheel. It's your first, most important measure of interest rate risk. Simple. Number 2, convexity is the handling and suspension. It's the critical second-order correction. And the simple rule is positive convexity is your friend, negative convexity is your enemy. And number 3, the real pros don't just manage the direction of rates, they manage the shape of the yield curve using advanced tools like KRD.
Okay, time for the hot seat. Let's run through some questions you are almost guaranteed to get. First up, the big one, the absolute classic. Here is your A+ answer structure. You're going to hit 3 points. First, the definition. Tell them duration is the first derivative, a linear measure, while convexity is the second derivative, measuring curvature. Second, their function. Duration gives the initial risk estimate, and convexity refines that estimate, making it more accurate. And third, lock it in with the analogy. Duration tells you how much the price moves, convexity tells you how much that sensitivity itself changes as rates move.
Okay, next question. This one is designed to see if you can connect the theory to the real world. They want to know why an investor should actually care about any of this. The key phrase you want to use here is asymmetrical return profile. That sounds smart, and it's exactly right. Explain what it means. In rising rates, you lose less than you'd expect, and at falling rates, you gain more. Then bring it home with the conclusion, this asymmetry acts like a natural built-in insurance policy against interest rate volatility, which is an incredibly viable feature for any bondholder.
And for the final boss question, this is the one that separates the candidates from the new hires. This is where you show you think like a real portfolio manager.
Your answer here needs to nail one crucial distinction, the difference between the level of interest rates and the shape of the yield curve. You'd explain that effective duration is your tool when you're worried about a parallel shift, the entire curve moving up or down together. But you use key rate duration for the much more realistic scenario of a non-parallel shift. It's the tool you use to hedge or even make a tactical bet on a change in the curve's shape, like a steepening or flattening. Nailing this shows you understand that risk isn't just one number, it's multidimensional, and that's exactly how the pros think about it every single day.